Danielle DiMartino Booth. She's CEO and Director of Intelligence for Quill Intelligence LLC, a research and analytics firm, and the author of the amazing bestseller, Fed Up, an insider's take on why the Federal Reserve is bad for America.
Greetings and salutations. This is Danielle DiMartino Booth. I'm CEO and Chief Strategist at QI Research, and I'd like to welcome you back to this next edition with ITM Trading. I think I'm possibly filming on the most uncertain day of my career as a former Fed insider, as a current Fed expert, Fed watcher, however you want to characterize it. I've never seen the controversy surrounding a rate cut or a rate hike for that matter. The real bit of background controversy got swirling at the end of last week when a Wall Street Journal story hit from the individual Nick Timrose, who's assumed to be kind of the Fed insider in the outside media, suggesting that a 50 basis point, a half a percentage point rate cut is what Fed officials were leaning towards. And that really set off a fist fight on Wall Street. My good buddy George Goncalves at MUFG, a big Japanese bank, as well as Michael Ferroli over at JP Morgan Chase, astoundingly so, they remain days later the only two big sell-side investment banks that are still saying the Fed should go a half a point. About everybody in the world has chimed in with their opinion, from other banks that are saying no, it's more prudent to keep it slow, to go only at 25 basis points, a quarter of a percentage point. And others have advocated really vociferously for the Fed to go ahead with that half point initial cut, right? At the July FOMC press conference, Chair Jay Powell stated there was a real conversation, quote unquote, a real conversation around a rate cut at the July the 31st meeting. So some are saying, well, if they were going to cut rates in July, why wouldn't they make up for that and go ahead and cut rates twice, if you will, at this initial rate cut meeting, first time in 4 years, right? It's been a long time since we've seen the Fed cut rates. It's been a long time also, as you can see on this chart, since the Fed last hiked rates. The longest time in history was the 15 months that preceded the Great Recession. And I think that has got a lot of market participants and investors a little concerned that the Fed has waited too long, because in the current episode, we've waited 14 months. So, is this a title fight that Jay Powell really wanted to win, given waiting too long? In that episode really was very costly for the economy. And the answer is we're going to find out, and we're going to find out pretty darn quickly. Let's hop forward and remind you that right now most of the calls on Wall Street have to do with current data that have been extremely prone to revision. In the last, since 2022, we've been seeing revisions come out. As you can see, the initial GDP print that we thought was the case at the outset of the 2001 recession printed at a very healthy 2.0%. And it wasn't until July of 2002, right? So 15 months later, that we actually had the revisions flow through to GDP data and tell us, we were actually in recession back in the spring of 2001. It takes a very long time to call recessions. And that's why people like me at QI Research have been looking at other signposts in the economy that are much more leading in nature to say, hey, wait a minute, the economy is already in recession. We already see enough evidence of that in the data that's going to subsequently filter through to future revisions. And therefore, the Fed is behind the curve. The Fed should be uh, cutting more aggressively at the outset of this easing campaign. And yet here we are on the eve of Fed Day, not knowing what the outcome is going to be with Fed funds futures pricing in, basically a 60% chance for a half percentage cut, 40% chance for a quarter of a percentage cut. And usually, if you want to write this down, uh, the Fed only makes a move if markets have priced in a 75% probability of them moving one way or the other, a hike or a cut. So that's typically where they want for markets to be, such that whatever the decision they make is, whatever the statement says, it doesn't shock the market. And if that sounds like it's the tail wagging the dog, that's the kind of the right cliche to attach to it. That is true. The Fed should not be following market pricing to make its decisions. And yet, really, since Alan Greenspan started at the helm of the Fed in 1987, August of 1987, that is indeed how monetary policy has been made. It has been beholden to the stock market and to Fed funds futures pricing. So, what are the ramifications? What you're seeing on this rather busy screen is kind of the post-mortem. What has happened since Greenspan was in office for those three big recessions that started in the United States? What was the 1 month and 3 month and 6 month forward change in given metrics? And as you can see, studying this, the S&P 500, for example, the longer the Fed waited, the more the payback was in the markets, the more the yield curve steepened, as you can see, kind of in that middle section, and the more interest rates fell, because the tighter you hold monetary policy, the longer it's going to take for the lag effects to play out in the economy, as we're seeing in the bankruptcy cycle. And what's really, really fascinating today is what markets have already priced in, and that is that the Fed is fully capable of engineering a so-called soft landing. This is a great chart that Deutsche Bank put out today that shows that markets are up more than 27% in anticipation of this first rate cut. The only other precedent that we have of markets rising as much as they are today in anticipation of the Fed engineering a soft landing was the 24% increase that we saw in 1995. But guess what? In 1995, we had a falling unemployment rate, not a rising unemployment rate. In 1995, we had not just seen 1 million full-time jobs destroyed in the space of the last 12 months, in the last year. And what does it mean to see 1 million full-time jobs destroyed? We're going to see a little bit of the evidence of how that's played out in an economy that I would remind you is 70% consumption. 70% of US GDP is consumption. So the economic output in the United States of America is dependent upon the money that we make, the paychecks that we earn. If we're making a full-time income, we're going to spend more. GDP is going to go up. If we're making less, then GDP is not going to be able to increase as much. And yet, really, markets have front run the Fed's ability to engineer a soft landing. It's quite incredible to see. And it's not just markets that are depending on the Fed engineering a soft landing. People who occupy the C-suites all over America, corporate America, we call it, CEOs, CFOs, the mentions on their earnings conference calls of rate cuts is the yellow line that you see. Very high. And the mentions of recession have come down quite a bit. Now, look back with me, if you will, at that red oval that I've circled. We saw a similar decline in anxiety about recession after the U.S. economy had already entered the Great Recession that started in December of 2007. There was a lot of similar chatter to what you're hearing today with the economic pundits on Bubble Vision, CNBC, Bloomberg TV, Fox Business, you name it. A lot of them, the majority of them back then, were saying the exact same thing that they're saying today. The Fed's going to be able to immaculately pull out a soft landing, and therefore they're no longer worried about recession. But funny thing is, in the Bank of America Fund Manager Survey that came out overnight, even though I think 89% of investment portfolio managers, if you will, active investment managers, 89% see the Fed having a great chance at engineering a soft landing. And yet, out of the last, in the last 11 months, these same investment managers have been very defensively positioned in their portfolios. They've all piled into utilities as if they're not exactly putting their money where their mouth is. They're positioning their portfolios, what they own, very defensively, and yet saying that there's no reason to be defensive, may as well own 100% NVIDIA in your portfolio. That kind of a thing. Why own gold when you can just rely on the Fed to engineer a soft landing? It's quite the dichotomy. It'll be interesting to see what this graph looks like a year from now, or even 6 months from now. What else are CEOs and CFOs doing? Well, they're cutting hours, they're cutting full-time workers, and as you can see, the number of part-time workers in the US economy is almost already at the height of the Great Recession. Remember, I said that there were multiple signposts that were already signaling, flashing red. Hey, we're already in recession here, people. Look at the number of part-time workers we've got. And we've seen even a more dramatic run up this time, because back then, Uber wasn't a thing. DoorDash wasn't a thing. If you wanted pizza, either Domino's delivered it to your door and you gave the delivery person a tip in cash, or you went to go pick up the food yourself. But things have changed. We're an on-demand economy. We want instant gratification. We want somebody to pick us up and drive us to the airport from our home. And therefore, the demand for things like Uber drivers, Lyft drivers, DoorDash drivers is very high. So rather than apply for unemployment insurance, Danielle, why have initial jobless claims been so low? Well, hey, if they're saying, in the state of Tennessee, I only get 12 weeks of unemployment insurance, or in California, they barely pay you $300 a week in unemployment benefits, why bother? Why bother applying for unemployment when you can go get a gig job in the economy and make a multiple of that in a given week? The question becomes then one of, and this is what I asked on a Twitter poll 24 hours ago, was at some point, are we going to see saturation in the number of workers required to drive us from point A to point B and to charge us a $10 fee to have the convenience of having lunch or dinner delivered to our front door? And that's a really viable question to ask, because if there is a ceiling here, then what that means, as companies like in the last few weeks alone, PricewaterhouseCoopers, we just saw a big announcement out of Boeing. They're going to be furloughing workers. Verizon just laid off 4,800. The list goes on and on. Accenture today, 750,000 employees worldwide, said it's going to be putting hiring on freeze for the next 6 months. It's going to wait 6 months longer than it normally would. And until then, nobody's going to get hired. If that's the current environment that we're in, and that we're seeing layoffs continue to increase, and that is indeed what you typically see once the unemployment rate starts to rise off its low, right? As it has done from 3.4% low to 4.2%. Once the unemployment rate rises off its low, it tends to go a lot higher. In right now, this current cycle, I would suggest to you that historically speaking, we're going to see at least 6% on the unemployment rate before things slow down and start to potentially recover if it doesn't get worse. So again, the question is the gig economy becoming saturated? Now, these are some readings out of the University of Michigan. The University of Michigan has a history that goes back to 1948. And we economists love long history because you can compare one cycle to another. In the case of in the case of individuals' expectations for what their paychecks are going to be a year from now, that particular series goes back to 1980. And what we've seen in the 6 months ended this September 2024, that lilac line that you see on the left-hand chart, is we've seen a 6 month spike in people's expectations that their income expectations are going to decline. We've graphed that in an inverted way to show you that the underemployment rate, right? The underemployment rate reflects people who are working part-time but would rather have a bigger income. They'd rather be working a full-time job and making more money. But the underemployment rate, the green line, has already picked up from a low of 5.5% in December 2022, and it's reached 7.9%. And again, given historic norms and the way that these two series act in tandem, we should be seeing a much greater increase in the underemployment rate. We call that the U6. The unemployment rate, the official rate, measures all employees. That's called the U3. But we should be seeing an appreciable continued increase in the underemployment rate. Conversely, on the right-hand side, that green line is showing you bad news heard on unemployment. It is already at recessionary levels. 29% of polled Americans have been hearing lots of bad news about the job market. Back in December 2007, when we were entering recession, that was 24%. So we're already 5 percentage points into the readings that we had during the Great Recession. Again, if we're counting, that's a third signpost that is already recessionary. As for income expectations being as dire as they are, right? That purple line is inverted, and it's been going up for 6 months. In data back to 1980, we've never seen anything like this. It's completely wiped the history books clean. Another clear signpost for recession, and yet we sit here, as we say, fiddling while Rome burns, discussing whether or not it should be a 25 basis point rate cut initially out of the gate or a 50 basis point rate cut. Another way that you can look at people's income, right? 70% of US GDP is consumption, is the percentage of people who are walking away when they decide to buy a home and then they back away. Well, why do you decide to buy a home and then cancel the contract? Maybe because you lost your job. And we're seeing a spike also in the percentage of individuals who apply for car loans and who are thus being rejected. Probably the biggest individual stock, not that I'm recommending or not the given stock, but we look at Ally Financial as being a bellwether for the broader economy because of how closely it tracks on this right-hand chart with higher unemployment expectations. You see that they move in tandem. So when Ally stock, which is depicted inversely, when Ally stock starts to fall, that means that they're seeing more losses on auto loans, and that will follow the economy into recession as it tracks upwards with people's perceptions of the job market. This is what we just spoke about on that last slide. I blew it up so that you could get one more look at it again. The reason I'm doubly emphasizing this particular chart is because we've never seen anything like this. And again, Danielle, there's so many other signs. Retail sales were up. That was reported this morning. I get it. But guess what? It was almost all driven in August, the upside surprise, by online shopping to a greater extent than what it was in July, which saw depressed online spending, which makes no sense because July was when we had Amazon Prime Day. And what does that tell you? What does it tell you? Excuse me, that we're losing record numbers of U.S. retailers right now. Why is that? Why is Big Lots closing all of its stores and deciding to move into liquidation mode, and countless other retailers? Why is that? Because they're having to drop prices. And that's why we're seeing online retail spending as strong as it is in the current environment, because people are looking online to get the lowest possible price. They're even buying groceries online. We saw grocery store spending decline in the retail sales data for August and online sales increase. I'm one of them. I'm guilty because I can find things online more cheaply than I can if I walk into a store. And that's what Americans are doing. So let's talk about politics for a minute because, oh, I don't know, we're just weeks away from the national presidential election. And obviously, the hands of the control could change for the U.S. Senate or the U.S. House of Representatives at the same time. But this particular election is really critical because if you look on that far right hand side, the youngest voters lean much more to the Democratic side than in prior decades. And that could mean, not necessarily, but if the young voters come out on election day, if they were agnostic to two octogenarians before President Biden dropped out of the race, and obviously a much younger Kamala Harris stepped into his place, if they were not going to vote on election day a few months ago, but now they're invigorated to vote for somebody who is a younger candidate and who might be more sympathetic to their needs. I need my student loans paid off. I'm paying too much rent. I need this, I need that from the government. I want more handouts. Then you could see them show up in numbers and swing the results of the election. Very feasible, just given the evolution of demographics in the United States that we've seen. Again, we've seen this is a change of the voting guard, so to speak. You've got your Gen Xers, your Gen Yers and your millennials who are going to be driving the results of this election. That's a regime change from generations in which the baby boomers have outnumbered the younger generations and voted with their pocketbooks in mind, not those of the younger generations. And what's critical right now is that even though Harris is ahead in the polls, right now it looks like we might have gridlock. This is data from just a few days ago that show that it's more likely than not, 73% chance that we're going to have a Republican Senate. We might end up staying with a with a Republican House, but it could easily swing to the Democratic side. But again, what we're seeing in the polls right now suggests that we could have 4 years of the White House butting heads with Congress and not a whole lot occurring legislatively, potentially to alleviate the distress of the recession. On top of this, and I have to bring this up. I'm beholden to bring this up. There's quite a large percentage of the population who's not going to be prepared. According to this latest ABC News Ipsos poll, not going to be prepared if Donald Trump does not win the presidential election. 67%, I would call an overwhelming majority. So, what happens in the event that the outcome is not what's expected the day after the election? And these are fair questions to ask as long as you're part of the U.S. economy. And I'll end this brief election preview, if you will, and kind of where we are with Fed policy, where we are in the economy. I'll end with this note. I get a lot of flack on my Twitter feed because I always say that if you bring up partisan politics on my Twitter feed, you will be blocked. There's plenty of other places to spew opinions on, denigrating one person or another person. So if you'll let me speak out of the other side of my mouth when I see charts like this, and that things like civil strife being a possibility could very much impair the U.S. economy, you also have to understand that whether we like it or not, economics is politics and politics is economics. By the same token, since Paul Volcker occupied the Eccles building and was chair of the Fed, which ended in August of 1987, we haven't had a more apolitical, nonpartisan Fed chair. So my message to you is that I think that this Federal Open Market Committee, this FOMC that's making this initial decision on the size of the first rate cut of the easing cycle of 2024 and 2025, maybe into 2026, we don't know. But this particular Federal Reserve is more data dependent than any we've seen since Greenspan or Bernanke or Yellen were in office, who were very much pliable and sympathetic to what individuals who wanted to influence Fed policy wanted to get out of them. That's not what's motivating Jay Powell. It's one of the reasons why the subsequent FOMC meeting that we're going to be having is going to be on a very unusual Wednesday and Thursday, the Wednesday and Thursday after the election. We always have Fed meetings on Tuesdays and Wednesdays, and yet Powell saw fit to move this meeting to a Wednesday and Thursday to not be viewed as even meeting in the midst of election day in the United States. So come what may with this rate cut, we will see how markets respond. We'll see how investors behave in the aftermath, and we will see how the economic data continue to unfold in the coming weeks and months, and that will dictate how far the Fed eventually cuts interest rates and how much it ends up being able to successfully shrink the size of its balance sheet, which is also critical. But I think if you appreciate the sheer level of uncertainty right now that is hanging over the US economy like a cloud, the weight of this uncertainty, I think, is one of the major factors underpinning not just things like defensive utility stock, but also gold prices. Because when there is the level of uncertainty that we have, it doesn't matter if we're seeing disinflationary and deflationary winds blowing, you will still see gold perceived to be a safe haven from the riskier asset markets. And I think that that's why we've seen gold prices so well behaved, even though the whole world knows that the world central bank, the Federal Reserve, is about to embark upon the first rate cutting cycle in 4 years. This is Danielle DiMartino Booth. I appreciate your listening and watching today, and I look forward to the next time we meet, and thank once again my great partners at ITM. Take care.